The email always seems to arrive on a quiet Tuesday. Congratulations, you have passed the evaluation. After 72 days of paper trading, 2 failed attempts, and nearly $300 in challenge fees, a prop firm you have never visited is suddenly handing you a $50,000 simulated capital account and calling you a trader. Of course, you screenshot it. You send it to the one person who might care. They do not fully understand what it means, so you start explaining the rules. And somehow, by explaining it out loud, it starts to feel real. The rules look simple. Stay above the drawdown threshold. Hit your profit target. Do not blow the account. You read the terms again and again, especially the consistency rule. You tell yourself that consistency is the one thing you actually have. During the first week, you make $340. Immediately, your brain starts calculating what that would look like if you could do it every week. The number feels ridiculous. You do not say it out loud, but you think about it constantly. Every position starts to feel personal. You screenshot the winners. You hide the losers. But strangely, the losses stay sharper in your memory than the wins. A winning trade feels good for a moment. A losing trade follows you for the entire weekend. One Thursday, you lose $180 and spend 2 full days replaying the entry. You find 6 reasons why the trade was wrong and 3 reasons why it was right. You choose to believe the 3. Deep down, you know this is not real money. You repeat that to yourself. But when the equity curve goes up, your chest feels different. When it pulls back, you check your phone every few minutes. The money may be simulated, but the stress is not. To your nervous system, it feels like everything. Eventually, you move into level 2, the rules lawyer. You start memorizing the firm's risk parameters, better than their own support team can explain them. Daily loss limit, 2%. Maximum total drawdown, 8%. Minimum trading days, 10. And then comes the rule that changes everything. No single trading day can account for more than 40% of your total profit. That rule nearly destroys your first account. One Wednesday, you catch a beautiful NASDAQ move. You add to the winner. You close the day up $2,100 on a $50,000 account. You feel like you finally understand the market. Then you read the payout policy. That one amazing day has now damaged your consistency ratio. You do not lose the account, but you learn a brutal lesson. The rules are not designed to protect you. They are designed to protect the firm's model. If your data fits their acceptable risk profile, you get paid. If it does not, the account resets, and they sell you another challenge. From that point on, you stop trading only for profit. You start trading for optics. You manage the shape of your equity curve. You stop taking your best setups when you are already up too much. You are no longer just playing the market. You are playing a game inside the game. Soon, you scale to a $100,000 account. It feels like a promotion, but really it is just another test. Can you keep the same discipline when they add more zeros to the screen? For 11 days you can, then you cannot. That is level 3, the drawdown. You do not remember every detail of the trade. What you remember is the feeling of watching a $3,400 floating loss bleed against you. You tell yourself the price action is still inside your model. Then the loss grows. You think, I will just wait for the bounce. But there is no bounce. The account hits the daily loss limit. The platform locks you out instantly. No phone call, no warning, just a cold red banner on the dashboard. You sit there quietly. You do not punch the desk. You do not scream. You just sit still. You have lost fake money in a way that feels completely real. The capital was never yours, but the challenge fee was. That night, you buy another challenge. You tell nobody. You wonder if this is discipline or insanity. You decide it is discipline. You might be wrong, but the second time, something changes. You no longer believe you are above rookie mistakes. You know exactly what you are capable of on a bad day. That realization hurts, but it also makes you clearer. You pass again, faster than before. Then comes level 4, the multi-account stage. Now you are running 4 accounts. 3 are funded. 1 is still in evaluation. You control more than $300,000 in total allocation across different prop firms. By this point, you know which firms use daily reset loss limits, which ones use trailing drawdowns, which ones pay on time, and which ones delay withdrawals. You build a spreadsheet to track everything. It is more advanced than anything you ever built in your previous job. Risk is no longer about one trade. Risk is now a portfolio. If you are long on 2 accounts, you reduce size on the 3rd. If 2 accounts are down on the day, you do not touch the 4th. You build your own system. And for the first time, the system feels bigger than your emotions. Monthly payouts start averaging $3,000. Some months are $5,000. One month reaches $8,700. For 1 hour, it feels surreal. Then it becomes a number you feel desperate to protect. That is when you start seeing prop firms for what they really are. They are businesses. The payouts are real, but the business model depends on most traders failing. Challenge fees fund the machine. A small group of disciplined traders gets paid, but the majority never reach consistent withdrawals. You realize you have become an anomaly. But that truth does not comfort you. You also realize that most funded accounts are simulated. You are not always trading real capital in the market. You are often trading inside a mirrored environment, while the firm decides what to do with the total risk on the back end. This should bother you more than it does. But the wire transfers keep landing in your bank account. The mechanism is strange. The output is real, so you focus on the output. And quietly, you wonder when you became that kind of person. By level 5, you reach the infrastructure stage. You stop fitting trading into your life. You start building your life around trading. Every morning you are awake before the open. You review overnight price action. You check economic calendars. You mark your levels. By 9:29 a.m., your hands are ready. By 11:15 a.m., most days, you are done. You do not trade the afternoon session. That rule was created after you lost $2,600 on a slow Friday because you were bored and imagined a setup that was not really there. You hire a coach. You call him an accountability partner because that sounds less dramatic. He charges $400 a month. Most of what he says, you already know. But saying your mistakes out loud to another human being changes everything. You realize discipline is not just personal. It is also social. You do not like that realization. You preferred the story that you were completely self-sufficient. Then taxes become complicated. You learn about contracts, capital gains, business structure, payouts, reporting, and documentation. You hire a CPA. She asks questions you cannot answer. So you spend an entire weekend writing internal documents for a trading business you did not even realize you had built. The money is real now, but the money is not what makes it sustainable. The infrastructure does. The spreadsheets, the risk protocols, the tax planning, the coach, the calendar, the boring systems. That is when you understand why most people who get funded never make it to year 2. The technical trading does not kill them. The weight of treating it like a real business does. Then comes level 6, the real desk. A message arrives on LinkedIn. A real institutional prop desk is looking for remote traders with verified performance. They want 6 months of statements. They want risk-adjusted returns. They want a call. You calculate your Sharpe ratio for the first time. Thankfully, it is acceptable. On the call, they offer you $500,000 in direct capital allocation with a 70-30 profit split. This is not a retail challenge account. This is real capital, direct market routing, live risk monitoring, a real risk manager watching your positions. In your first week, a risk manager named Derek calls at 10:47 a.m. Your NASDAQ position size is above the approved limit. Derek is not angry. That makes it worse. He calmly tells you exactly where the limit is, where you are now, and what you need to do. You reduce the position. He hangs up. No friendly goodbye. You sit there for a moment. Being monitored by a human feels completely different from being monitored by software. The pressure is heavier. The desk has expectations. They are not just hoping you avoid failure. They expect you to extract money from the market. Challenge accounts cannot fire you from your career. Derek can. And you trade differently when you know Derek can call. Level 7 is the book. The firm gives you responsibility over a position book. Not a physical book, but a portfolio of strategies you are responsible for managing. Your allocation grows to $1.2 million. You trade the S&P, NASDAQ, and crude oil. The pressure becomes more complex. Other traders' performance can now affect your own opportunity. If someone in London has a bad quarter, risk limits tighten across the desk. You learn that your income is no longer only tied to your execution. It is tied to the wider machine. You have a brutal losing month in September because of volatility you could not control. You do not complain. By now you know that complaining about a system you cannot change is just wasted energy. You adjust. A losing day is not failure. A losing week requires review. A losing month requires a formal explanation to the risk committee. You give your first monthly review presentation. 12 slides. You spend more time perfecting those slides than you spent on almost anything else that month. The committee asks sharp questions. You answer cleanly. They approve a capital increase. For the first time, you feel like you actually work somewhere. Then level 8 arrives. The cost. Your girlfriend asks when you last took a full weekend off. You stop and think. The answer is February. It is now October. She says nothing. She does not need to. You know the market opens Sunday night. You know the Fed decision is Wednesday. You know the report's dropping Friday. Macro events occupy your mind the way friendships used to. In your first full year on the institutional desk, you make $187,000. After taxes, fees, subscriptions, data feeds, and everything else, you keep around $94,000. You expected to feel proud. Instead, you feel tired. Your identity has collapsed into one cold sentence. You are a trader. Everything else is either support for that identity or noise. You lose friendships this way. You tell yourself it was necessary. Maybe it was not. 3 years earlier, you thought trading would give you freedom. Now you realize you were not looking for freedom. You were looking for flexibility. And right now you have neither. You have precision. You have capital. You have competence. But only inside a very narrow world. You are not sure whether that is success or a trade-off you can never reverse. You finish the year with a 14.2% return. The desk is pleased. They increase your allocation again. By level 9, you become the architect. You do not have an official title. But junior traders come to you when they struggle with sizing. Derek calls you when a major macro event hits overnight. The desk wants your read before the open. You never chase that position. It's simply formed around you. Now you are running $4 million. It is not your money. It was never your money. But your fingers move it, and that distinction feels smaller than it used to. You have made mistakes at this level that cost more in one afternoon than you made in your entire first year. But you process them differently now. You document the anomaly. Review the execution. Update the model. Move on. Emotion has been rerouted into process. You do not know if that is maturity or psychological damage. Then you start thinking about building your own firm. Not seriously at first. But the thought keeps returning. You know the infrastructure. You know the risk model. You know what kind of traders you would hire. You begin to understand something important. The system you spent years learning to navigate was built by someone. And that person probably once stood where you are standing now. The machine was built by a trader who became an architect. Now you are becoming one too. Finally, you reach level 10, the overhead. The office is quiet because you designed it that way. 4 junior traders are running under your book. You review their equity curves every morning before the open. You speak with prime brokers by first name. Your Thursdays are filled with compliance calls. You no longer trade the way you used to. You trade less. You think more. The edge is no longer just execution. The edge is structure. Who you hire. How you size risk. How you design rules. How you negotiate leverage. How you protect the firm from one trader's bad week. Someone asks you at dinner what it feels like to run your own boutique trading shop. You think for a moment. Then you say, "It is a lot of overhead." They laugh because they think you are joking. You are not. The overhead is real. Compliance, payroll, risk limits, capital conversations, letting go of a talented trader after a bad quarter, watching your best trader get poached by a larger fund and deciding whether matching the offer destroys your own economics. The firm makes $2.1 million in net P&L during its second year. Your personal cut is large enough that the number itself is no longer the interesting part. The only interesting question left is whether you still want to sit in this chair. You do not let yourself think about that for too long. A major macro event is coming Friday morning. The desk needs a briefing. You close your laptop at 8 p.m. The office is empty. You are the last one there. You are almost always the last one there. And somewhere tonight, someone has just paid $297 for a challenge account. They have watched hundreds of hours of trading videos. They have highlighted every risk rule. They believe the hard part is learning how to trade. They have no idea what they are actually building toward. But they will find out soon enough. I did.